Today we are analyzing General Motors Company, ticker GM. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $55 billion, enterprise value of $100 billion. There's an astronomical $45 billion in net debt on this business, which is absolutely huge for a business of this size. This is operating in the automobile industry, and it means that your debt is almost half of the entire enterprise value of the business. This is a very leveraged company. General Motors designs, builds, and sells trucks, crossover cars, and automobile parts and accessories in North America, basically the whole world. But of course, they're primarily based in the United States. They have GM North America. It has brands under the Buick, Cadillac, Chevrolet, GMC, Holden, Baoju, and Wuling brand names. So they sell trucks, crossovers, cars, etc. And also they have various pieces along that, selling to fleet and retail, things along those lines. But basically, this is a car company producing under the brands Buick, Cadillac, Chevrolet, GMC, Holden. These are more of the U.S. brands, and I think these are some of the non-U.S. brands. Beta is a 1.35. That means about 35% more volatile than the average S&P 500 company. Now let's get down to this return on invested capital chart, which tells us almost nothing on the visual because 2009 was an astronomical loss, negative 101,000%. This is basically what? Bankruptcy. I don't know if GM went bankrupt or if it was just the financial part. But clearly this business started over in 2010, and it looks like a flat line because everything is so small compared to this number. So I'll just have to read off these numbers. We have 14%, 18%, 11, 8, 4, 10, 8, negative 3%. So they did lose money in 2017. 5, 4, 4, 5, 5. So they lost money 1 year since the financial crisis, and in general have hovered in that 4 to 5% range for return on invested capital. And we can see that matches up well with this 10-year median return here of 5.5%. This number is quite low. It's not uncommon for a car type company to have a number in this range, but I would really like this to be a double-digit number, and so we're about half of my target value. Now, because of the massive amount of debt leverage on this business, they're actually turning this into a return on equity of about 15%. My goal is a 15% return on equity combined with a 10% return on invested capital. So is it good enough if return on equity is 15%, but because return on invested capital is this low? I'm hesitant to say yes, because the reason I chose this 10% number here to drive into a 15% return on equity is it requires less leverage. The only reason you're able to do this is there's a substantial amount of leverage, and that leverage equates to risk. Leverage, risk, debt, risk. That's how you need to think about it. And so when I see this, I see a very risky company hitting my return on equity target, but that risk is there. A loss like this in 2009 clearly showing this isn't a high quality business. This is probably more like an average business from what you see here. They're able to hit a decent return on equity, but it's requiring leverage because they're a low return on invested capital. Everything here would say it's average. Now, the valuation is anything but average. The valuation looks very, very cheap. You have a PE of 5.6, price to book of 0.8, price to sales of 0.4, EV to sales 0.6. All of these valuation metrics say this business is cheap. The average S&P 500 company trades historically at a PE of 15, so this is 1/3 of the average PE ratio for an S&P 500 company. Price to book below 1 is always an exciting metric where you're hitting. Price to sales at 0.4. So this is all aligned to say, hey, this is a relatively cheap company. So this is not a high quality business, but it is an average business at a very cheap price. Keep that in mind. Now, the 10-year CAGR on growth is quite poor. Now, we are going back to 2013, and so you have to think about the auto market, and they just came out of COVID, which was an absolutely horrendous period for the automobile manufacturers. You see, in 2013, they were earning $155 billion in revenue, and that got down to $127 billion in the worst part of COVID, $122 billion in the worst part of COVID, 2020 and 2021, but they did get back up to $156 in 2022. So you see that 23% growth rate in revenue over the last year. So although this says revenue is flat, you had quite a volatile period of time because you did drop significantly going into COVID. Now, is COVID repeatable? I wouldn't think COVID's kind of a repeatable instance that we need to be worried about, but it is something to be aware of that because of that, they haven't had this slow and steady growth. They're just kind of flat across the decade. I'm not really interested a lot in companies that aren't growing, but if I was, then getting them at a price PE ratio of 5 is where it starts to get really attractive. A PE ratio of 5 means you have an earnings yield of 20%. You don't need to grow to give me a double-digit return if you're trading at a price like that. And so that's always pretty interesting. You see this this earnings in 2022 of $6.13. You're only trading at $37. So PE of maybe 6 based upon that number. Again, that's a very attractive number. You're talking about 15 to 20% returns simply if they paid out all of their cash and they didn't grow at all. Now, the problem does appear that their dividends aren't matching their earnings per share. There's a lot of retained earnings here. So where are those earnings going? Because it's not leading to growth, and that would be a concern of mine. But we can see that although the revenue has been flat, you've actually increased your gross profit by about 10%, and you've increased your operating profit by 100% over the course of a decade. So they've been really good with operating leverage because they've turned a flat revenue into a 7% EPS growth rate. And EPS is really all we need. We don't need growing revenue if you can continue to manage your business in a way that grows your EPS. And so you've more than doubled your earnings. You've almost tripled your earnings over the course of a decade, especially if you went from 2013 to 2021. You can see basically over that time period, you're earning over a 10% growth rate on EPS. I don't know why it's giving me this 7.7% number because the numbers clearly here show that it's growing faster than 7%. 7% would mean doubling in the course of a decade. Your operating profit definitely did double over the course of a decade. But the earnings are growing at a much faster rate than that. And so that actually looks quite good from an earnings growth rate because this is a double-digit number. But again, I wouldn't necessarily think that's repeatable, but we're going to have to dive deeper into the income statement to really get a sense of that. My biggest concern is where is the cash going? Because it's not going in dividends. Is it going in share buybacks? What are we doing with the cash? Because if I'm trading at a PE of this, I want the cash. I want you to pay it out to me, especially if you're unable to grow. And so that's where I'm thinking about it right now. If you're enjoying this video, if you're liking it, please hit that like button. That really tells YouTube you're enjoying the content. And we're going to dive into the income statement, balance sheet, and cash flow statement. I hope you'll stick around with us as I try and get as much value as possible so you'll become one of my subscribers. Now, we see that one of the reasons they were able to get this massive boost in operating profit is they had flat revenue. You can see this flat revenue. They kept their cost of goods sold down, which allowed them to grow their gross profit by 10%. But although they grew their gross profit by 10%, they actually cut SG&A. So their SG&A is down 20%, which led to a really amazing operating leverage because they turned a $2 billion increase in gross profit into almost a $5 billion increase in operating profit. That's very rare. It's very disciplined from the managers of this business. So I'm impressed by what I see there. That's very good for shareholders, how this business has been managed. Now, you can see that net interest income was, negative $88 million at the beginning of the decade, and now they're paying basically $500 million in interest. And so that is one concern that they've probably leveraged up significantly on the debt path in order to make this situation happen. So there is a little bit of a concern there. Let's see. We do see shares diluted of 1.6 billion has dropped down to 1.4 billion. So you've basically retired somewhere between 15 and 20% of their shares outstanding over the course of a decade, which is pretty good because that means that you basically are adding 1 to 2% per year to your EPS growth rate simply due to those share buybacks. And it is why your net income, which hasn't fully doubled, has led to EPS more than doubling. And that still holds true on these numbers. So I don't really understand why this is showing 7.7%. It should be above 10% based upon the numbers we see here, which would be fantastic, especially for a company of this size in the $100 billion range. So I don't have any concerns from it on that end. I do think you probably got a little bit of boost from the Tax Cuts and Jobs Act. It looks like you had a really big one-time income tax number here in 2017, which means that this wasn't really a net income loss. You had positive operating profit, you had positive pre-tax income. This shouldn't really be considered from a shareholder point of view as a loss. It looks like they made money every year since the financial crisis. Your big concern is, can the financial crisis type result happen again? They were able to still make a profit through COVID, so I'm not that concerned as a shareholder. It looks like they've managed it well through a relatively tough period of time. Let's go to the balance sheet. Immediately, the thing that I want to understand is PP&E and debt. So PP&E has tripled. That's a little bit of a concern. You've gone from $25 billion in PP&E to almost $80 billion in PP&E. Inventories are flat. So you see inventories were 15 billion, 15 billion. But again, your PP&E is up $52 billion. How's your debt? Your debt is up $65 billion. Your debt has increased massively. One of the things that's clearly happened here is just a recapitalization of how this business is being run. It was run before with relatively little debt, $10 billion. And now it's run with a lot of debt. Now that debt is going to basically match up with the PP&E I have here. So in that sense, it's kind of okay. It's a way of leveraging the balance sheet, making it a little bit more effective for shareholders. It's what's allowing us to turn this 5% return on invested capital into a 15% return on equity. So I can't say it's a bad decision from management because it's clearly worked out in how they've done it. But the thing that you have to think about is you always need to compare that to revenue. So this went from a business that had $25 billion in PP&E, earning $155 billion in revenue, to now having $75 billion in PP&E, earning $155 billion in revenue. So their capital returns on their base assets have gotten substantially worse over the last decade. And that's actually a really negative sign because it means you can't keep doing that. You can't you can't replicate this and triple PP&E over the next decade and expect that to work out. If you tripled it from here, you're going to be talking about like $220 billion in PP&E. And this business can't support $220 billion in debt. It can clearly manage the debt they have now. But again, you are quite leveraged. I mean, you have $75 billion in debt. Your income is $10 billion a year. So you have 7 years income worth of debt. So this is a very leveraged business. I'd be really concerned that they can't really leverage it up any further than they have. And so it does make me question how can they manage this as well going forward. So cash flow from operations, one of the things that's, of course, always a good sign is you see positive cash flow in every single year. This is, again, validating that 2017 wasn't really a true loss there. But it is something to be aware of. Now, what's interesting, this is interesting, depreciation amortization at the beginning of the decade was being outstripped by how much they were investing in PP&E. They invested a lot in 2015 through 2017, but they've hardly invested much at all over the last few years, and yet the depreciation's still big. So have we seen it coming down? Let's go back to the balance sheet and tie this in. You have seen PP&E decreasing. You see this $82 billion, it peaked in 2018 and has been coming down since then. You've lost $5 billion, and part of that is because your depreciation is so much bigger than your PP&E spending now that you're actually reducing your asset intensity. And if that continues, that's actually a good sign, kind of offsetting what I was saying before. You would like to see that PP&E, intensity of this business, the capital intensity of the business come down because that's a really high number. One piece here as well, there's all these other expenditures. These other expenditures are just so high, it makes it really hard to kind of like make sense of what is this other expenditure. You'd have to dive into the 10K because clearly this is a number, when you think about other expenditure of $16 billion, that's completely offsetting this cash from operations. So that's just such a big offset to really know where is that money being invested because it's clearly a large part of their business. You can see, of course, they had buybacks at the beginning of the decade. They basically have had no buybacks the last 5 years. A lot of debt issuance, just a lot of debt issuance. Very little paid in dividends. So all the cash is going here. That's one of the things, that original question is where the money going? Where's the money going? If they were paying out money to shareholders in dividends and buybacks and weren't having to reinvest a lot in the business, this could be a very exciting opportunity because you're paying a PE of 5 or 6 is a very cheap price. Even a poor quality company that's not growing, you can make a lot of money buying at a PE of 6 as long as the cash is being paid out to you and not being sunk into a business that it's never going to come out of. My concern here is I think this money is being sunk into this business, at least based upon the evidence I have here. Now, if management comes out, they change their capital allocation strategy, say, hey, we don't need any more money in this business, that's one thing. But I have a feeling they're probably investing a lot into electric vehicles and things like that, which could be very capital intensive. And so that would be a concern of mine. And for that reason, I'm going to pass on General Motors. In summary, high quality company, average or no, sorry, not a high quality company. It's an average company at a very cheap price. And so if the capital allocation was right, this could be an amazing opportunity. From what I see in this data, it doesn't look like the capital allocation is right, but that's probably worth some bigger digging for those who want to look into deep value type investments. If you learned something in this video, if you like my content, please hit that like button. Great way to tell YouTube you support this content. And the even better way is to click subscribe. Become a subscriber. I'm doing 3 videos a week, S&P 500 companies right now, trying to help you learn to become a better investor. And if you want to see the companies that I really like, my favorite companies, those are my watch list stocks, and the playlist will be available at the end of this video. And so, if you want to learn and support the channel, great way to do that is to go to quickfs.net. Use my affiliate link, first description link in the description below. That will let them know that I sent you. It's a great way to support the channel. I get, of course, a commission if you sign up using my link. So this is the one I use for my own investments to figure out stocks. So I hope you will check it out as well. Thank you for listening, and until next time, stop paying fees, start building wealth.